Those interest rate sensitive sectors really struggling on the day. We're going to talk about all of this and more with Harry Colvin, Longview Economics Director and Senior Market Strategist. He joins us now. Harry, thanks for being here with us. Talk to me about which corner of the market was the most prepared for this upside surprise in the CPI print.
Well, it's funny you say that. I think markets actually have been quite well prepared generally. It's with many people calling for a bit of a wobble in markets. And in fact, if you look at downside put protection in portfolios, that's been picking up generally. So a little bit of a wobble, and it's, as you say, it's towards the sectors you would expect, particularly those defensive bond proxy type sectors, not surprisingly. But markets, I think, have been a little bit prepared for a wobble, which is why I don't think we're going to get much weakness in this equity market.
Can I follow on that quickly, Harry? Because I'm curious about what makes you think the market was prepped for this. We've seen that over the past 7 days, it's kind of depressing for the market because it's the first 7-day stretch without a record high so far this year. We've just had record high after record high. Where in equities are you seeing preparation for a higher for longer environment with that kind of a rally?
Yeah, I mean, look, I'm really referring to this big pickup we've seen in the put to call ratio on the CBOE. Investors protecting their portfolios to the downside, and therefore, because they're protected with options, there's no real selling pressure in cash equities. And as well as that, more anecdotally, there have been lots of commentators out there calling for a pullback in equities. And of course, pullbacks don't happen when everyone expects them. They happen when there's euphoria and complacency and more calls for further gains in equity. So I think in that sense, this market's been quite well prepared for a little bit of weakness.
Harry, the weakness that we're seeing today, do you view this most likely as just a temporary blip?
Yeah, I think this is a little consolidation within an ongoing uptrend. I think we're in quite a low volatility environment. The buy the dip psychology is still working. And of course, rates are rising. Bond yields backing up, the dollar's been strong. There are things to worry about, and I think that's why we've had this pickup in downside put protection. But let's not forget that's been happening all year. Upside surprises in inflation, higher rates, higher dollar, but actually equities have rallied anyway.
So what would be the next catalyst to have this market pricing in a rate cut in November, as late as November?
Well, look, I think we need to start seeing some softer inflation numbers and other evidence that inflation's about to soften. And arguably, we are beginning to see that in some parts of the US economy. If you look at the forward-looking indicators for the labor market, almost all of them are rolling over. Hiring intentions are down. Part-time workers in the service sector, they're falling. That's normally the type of labor that gets cut first before other job losses come through. The number of people working part-time because they can't find a full-time job, that's trending up. You know, if you look at the Kansas City Fed labor market index, that's rolling over, and that aggregates all kinds of forward-looking indicators like new hires and quit rates and things like that. So I think pretty much wherever you look, there is softness coming in this US labor market, and that should then feed through into service sector inflation and into interest rate expectations. So I think that's the key catalyst. That's the key trigger we want to look for over the next few months.
Harry, do you think this inflation print, has that pretty much killed any sort of odds that we are going to see a June rate cut?
I think it probably has. I mean, unless we get some real marked deterioration in some of the macro and inflation type data over the course of the next month or two, then yes, that's looking less likely and probably cuts more of a story for the second half of the year.
All right, Harry Colvin, we appreciate you taking the time to join us here at Longview Economics Director and Senior Market Strategist. Thanks, Harry.